Good evening. Thank you, everyone, for coming to attend this evening. We've got quite a lot of material to get through, so let me get straight into the presentation. And I thought there was three core questions that we need to answer this evening. Why have US bond yields trended down over the last decade? I know short-term focus is very much on the upcoming Donald Trump presidency, but everything must be put in context. What's the outlook for yields over the next 2 to 3 years, not the next 2 to 3 months? But nonetheless, on a short-term basis, why have bond yields jumped so much in the last 3 months since the US election? We're going to answer the first two questions and come back to the third question a little bit later. Let me slow down a little bit. Why have bond yields in the US generally trended down for the last decade? It's demographics. The US is an aging population, and you can see from the chart that it's leading to decelerating working age population growth. This will come as no surprise in Japan that as a society ages, the trend rate of economic growth also decelerates. The working population 10 years ago was growing near sort of 2-3%. It's now only growing at 0.5%. Translating that into monthly employment gains, basically it's about 100,000 jobs per month to maintain the unemployment rate. And as you know, over the last few years, the US unemployment rate's fallen by about 6%, and it's achieved that despite growing at GDP growth only a little bit above 2%. The US economy has been growing above trend, unemployment has been falling, and this gets into the critical question of why does the US Fed want to put up interest rates? It's because the US economy has been growing too quickly. Let's put this into visual form. This is the monthly US employment data, which we follow obviously closely each month. On average, be it a 3-month or a 12-month moving average, we've been growing US employment at about 150 to 160,000 new jobs per month. The Fed needs to slow this down to 100,000. It needs to basically tap on the brakes a little bit and slow economic growth. If it doesn't, then as the labour market tightens, you'll get accelerating wage growth and the Fed's inflation mandate will come under stress. But they're not in any great hurry. We reckon they've still got about another 18 months to achieve this deceleration in monthly employment growth. Let's put that into words. We're expecting the Fed to raise rates 25 basis points every 6 months until we get to about 2% on the Fed funds, and that will occur late in 2019. How's the bond market going to react? Well, remember, growth in the US is decelerating because working population growth, demographics is a headwind, and the Fed wants to slow the rate of growth. There's no reason why the bond market will sell off or get worried about this. In fact, we think it would take it quite positively. And in economic terms, we look at the yield curve, the difference in the bond yield versus the Fed funds rate. In a tightening period, and the Fed's been tightening for since 2013, basically as rates go up, bond yields, in anticipation of slower growth, don't go up very much themselves. And so we have, as I said before, a 2% Fed funds target by 2019. We have the cycle high for US bond yields at 2.7%. And about a month ago, when bond yields got up to 2.6%, this was obviously a very nervous forecast. But happily, as you no doubt follow the market as closely as we do, bond yields have begun to fall again towards 2.4. As the Fed raises rates, the bond market will take confidence that growth will be nudged slower, that the labour market will essentially soft land, and that the yield curve will anticipate that. And as in previous cycles, we'll end up with a bond policy rate spread of about 70 basis points, i.e. towards the B point on this arrow. So before we get on to President Trump, we've got the very strong demographic factors restraining bond yields, and we've got the Federal Reserve tightening monetary policy in a normal cycle, which also will be a headwind, we think, for bond yields. As bond yields go up again, as policy rates go up, the bond market will take comfort and basically be quite stable. So those are the first two questions. why, if I'm talking about this overall placid controlled environment, have bond yields moved up so rapidly in the last 3 months? They went up from about 1.7% to 2.6%. That spike on the right-hand side of this chart. There's a lot of numbers on this page, for which we apologize, but there are global business cycles. And if I remind you, back 12 months ago, there was a lot of pessimism. Global industrial production had been decelerating through 2015. There was a lot of concerns on China. The RMB was looking very vulnerable, very weak. But what we were basically experiencing back then was the bottom of the business cycle. And from the beginning of 2016 to now, there's been a very strong cyclical recovery. The chart on the left is the manufacturing PMIs. It's a survey of manufacturing sectors. And again, 12 months ago, it was bouncing around the 50 level. As you can see, there's been a very strong recovery in the last 6 to 9 months. On the right-hand side, you get the OECD leading indicator, and this is a forward indicator of growth in advanced economies. And it hit its weakest point again about a year ago, back in February, March, and has improved every month for the last 8 months, having actually now turned positive in the most recent data point. So there was clear indications of cyclical recovery. And when you go out into the real economy and measure global industrial production, this is the red text beneath the chart on the left. It was at its weakest in December 2015, just 0.4% year over year. In October, it had already recovered to 1.8% year over year. And since putting this presentation together, we've had the November number when global industrial production year over year was growing at 2.8%. Again, there's been a very strong global industrial recovery in the last 6 to 9 months, but the bond market wasn't picking up on it. Remember, the bond market was stuck at around 1.6, 1.7, and it was getting behind the global recovery curve, such that what we've had in the last 3 months has been the bond market catching up with the global cycle. Let me skip over this chart. I don't really need it, but it's a reassuring chart that you're getting private sector borrowing coming back in the US and Europe. So the balance sheet recession that we had in Japan for 10, 12 years took about 5 years to clean up in the US. It's taking about 9 years in Europe, but we're getting through those adjustments. But let's have a look again at the bond market. You can break bond yields down into 2 components. There's a real growth element, the red line, and then there's an inflation compensation element, the blue line. And if you look at this chart sort of 3 months back, the red line was relatively low, not picking up on a very strong global industrial production recovery. And the blue line was beneath the 2% longer term average, again reflecting, let's say, economic cycle concerns. Why was the bond market so slow to pick up on the global business cycle recovery? It was probably because it was a global business cycle recovery, i.e. in the US, the worries were still very much about whether or not the US economy was going to accelerate or not. Nonetheless, with the arrival of President Trump and let's say initially optimism on growth in the context of that global growth, we've seen the red line move back towards recent averages and the blue line move back to longer term averages, i.e. it was a catch-up adjustment, and that's now largely complete. If you look closely at this chart, we've got inflation sort of running on a longer inflation compensation running at about 2.2. We've got the red line maybe at about 0.5. Put the two together, you get to that 2.7%. So before we get into President Trump, let me just summarize again. The reason why we don't expect a big increase in bond yields going forwards is the headwinds to growth and demographics, the Federal Reserve tightening into the cycle, providing reassurance to the bond market that economic growth is not going to run away, it's going to soft land in terms of the labour market. And whilst we've had a big move in bond yields, it really has reflected the lagged catch-up to the recovery in the global cycle, which is already behind us. Remember, November global industrial production up 2.8%. That's basically as good as it's going to get, we think, for this cycle. Trumponomics. It's going to get confusing. It's going to get confusing because there are so many different scenarios. We've tried to simplify it here. Remember the previous chart? We had the red line looking at growth. We had the blue line on inflation expectations. Looking at policy proposals, there was initially a lot of optimism after the US election that you'd get a big boost to growth from infrastructure spending. That appears top right under inflationary expectations. If you've got an economy almost at full employment, with the Fed trying to slow growth, and you layer on top a massive public expenditure program in relatively low-skilled activities, you have to attract that labour from other parts of the economy, and that basically is wage inflation, inflationary expectations. That's why this is one interpretation for why the US bond market was selling off so quickly, that the Fed would have to accelerate its interest rate policy rate increases. We don't think this is a particularly high priority of President Trump. We won't know until Friday the ranking of his priorities. But in his comments, he's always talked about a decade-long program providing tax subsidies to empower the private sector to deliver on infrastructure spending. And so why is that different from the government just going out and spending the money itself? Well, the government would tend to spend the money, a lot of it would be sort of badly planned and wasted. When the private sector does it, obviously looking for good returns and everything else, you've got a planning stage, you've got a regulatory stage, you've got a contract writing stage. It tends to take longer to arrive, but be much more productive. And of course, if it's more productive, it tends to be less inflationary, rather than, let's say, a big infrastructure spend that dissipates in poor projects. But we don't know what the priority of relative priority of infrastructure spending is. We just know that he's talked about it a lot. On the other side, the tax reform proposals, the idea that they will cut US corporate tax rates from 35% to 20 or possibly as low as 15%, again, initially excited the market after the US election. That was one of the reasons that the equity market pushed to new highs. But the more people investigate the tax reform proposals, they realize that to finance the cuts in corporate tax, the proposal is to introduce something called a border tax adjustment. Let's simplify it. Let's call it protectionism. Let's call it a tariff. Let's call it basically funding the corporate tax cuts by taxing imports. Bottom left on this schematic, obviously protectionism hits growth. So initially after the election, people saw supply-side tax reform and got optimistic. And then when they got into the financing of what they were optimistic about, they discovered that it would be very damaging for growth. Protectionism also has implications for inflation. Obviously, if you put up tariffs, it's upward pressure on import prices, upward pressure on inflation. I said it was going to get confusing. I think what we need to do at this point is tell you where we think the most likely outcome is. We think he will certainly go for supply-side tax reforms. The congressional Republicans are very keen on this. And in one form or another, he will go for protectionism. He said it in too many forms over the election campaign. Whether it's a broad border tax adjustment, whether it's targeted at individual companies like countries like Mexico or China, or in the last few days, whether it's just an attempt to talk the currency down to gain a competitive advantage through, abandoning the strong dollar policy. We're not sure the form. We'll be a lot more confident after Friday. But in one form or another, America First is going to involve trying to reduce the trade deficit. With apologies to the translators, I'm going to give you some numbers that aren't in the presentation. The US trade deficit is broadly $700 billion. Half of it comes from China. China has a very unbalanced trading relationship with the US. For every $1 that the US exports to China, China exports $4 to the US. So China's exports to the US are 4 times America's exports to China. It's a very easy target for President Trump to try and improve from the American perspective. And he's talked about this, as I say, in a variety of manners. But in terms of how quickly he'll move, nobody knows. And again, on Friday in the inauguration speech, it's really important to see what his priorities are going to be. It appears that Obamacare, a domestic policy issue, is at the very top of his agenda. From the perspective of the bond market or global growth, that's not important. but it's highly likely that an activist trade policy, protectionism, will be in his top 3 priorities. So just to conclude at this point, there's demographic headwinds, there's the Fed trying to slow the economy, which again is supportive to keeping bond yields low, and there's a variety of outcomes from policy, but if they do include protectionism, it's very negative for growth, and again would be a reason why bond yields stay low and certainly don't move significantly higher. So again, our expectation is a cycle high in bond yields of no more than 2.7%. Let me pause there and see if there's any questions.